Welcome to The Explainer. Today, we're diving into a full, deep dive due diligence report on MannKind Corporation. You'll see them trading under the ticker symbol MNKD. Now, if you're not familiar, MannKind is this really fascinating biopharma company. They're totally focused on transforming chronic disease care, specifically creating innovative, patient-centric solutions for cardiometabolic and orphan lung diseases. But here's the thing. If you follow the biotech sector at all, you already know that valuing a company with a heavy research and development pipeline is, well, it's incredibly tricky. And right now, MannKind is presenting us with a brilliant mystery. We are essentially looking at a classic standoff between cold, hard financial modeling and a deeply optimistic corporate narrative.
Okay, let's dive right into this. Here is our roadmap for today's due diligence. First up, the valuation paradox. Then, revenue surges and financials. Third, commercial portfolio growth. Fourth, 2026 pipeline catalysts. And finally, risks and our final verdict.
All right, Section 1, the valuation paradox.
Let's kick things off with the bear case, shall we? Independent discounted cash flow, or DCF models, are painting a pretty bleak picture right now. So these models use a weighted average cost of capital of 8%. Think of that as basically the baseline return investors demand just to justify taking on the risk. Combine that with a long-term growth rate of 4%, and a recent DCF valuation prices MannKind at just $3.09 per share. Now stack that against a recent trading price of $4.13, and yikes, you're looking at a negative 25.1% downside. Because of that steep mathematical drop, these strict quantitative models are slapping a firm sell rating on the stock. If you go purely by the math of projected cash flows, the market is overvaluing this company.
But hey, you can't do proper due diligence by looking at just one side of the coin, right? Let's pivot over to the bullish counter-narrative. MannKind CEO Michael Castagna recently went on the record and flat out said 2026 is the most catalyst-rich year in the company's history. He is arguing that with some massive product launches on the horizon, the company is perfectly positioned for long-term value creation. So here's our paradox. The strict financial valuation tells us to sell and brace for a 25% drop, while the CEO insists they've literally never had more upside potential. So who's right? To figure that out, we need to dig into the actual data.
Moving on to Section 2, revenue surges and financials.
The latest numbers perfectly capture exactly why management is so insanely confident. Just look at their record-setting fourth quarter from the latest press release. They generated $112 million in total revenue. That is a staggering 46% increase over the prior year. When a biotech company crosses that $100 million mark in a single quarter, especially with that kind of year-over-year growth, that's a huge deal. It signals a major, tangible shift in commercial viability.
Now you might be wondering, was Q4 just some seasonal fluke? Well, the data says absolutely not. Looking at the freshly reported Q1 2026 financials, we're seeing sustained top-line momentum. Total revenues for the first quarter hit $90.2 million, and that's up from $78.3 million in the exact same quarter last year. So that's a rock-solid 15% year-over-year revenue jump. The top-line growth is undeniably robust, which for sure backs up the CEO's growth narrative. But of course, real due diligence means we have to look at actual profitability, not just sales. And this is exactly where the DCF model skepticism starts to make a lot of sense. While revenues are surging, the bottom line is telling a totally different story. In Q1 2026, MannKind reported a $16.6 million net loss. Contrast that to Q1 of 2025, when they actually posted a $13.1 million net income. So why the sudden nosedive into the red? Well, their operating expenses practically skyrocketed. Research and development expenses jumped from $11 million to over $17 million. Selling, general, and administrative expenses, those more than doubled to $54 million as they aggressively built out the infrastructure for upcoming launches. Plus, they dropped cash to settle $36.3 million in convertible notes. The takeaway here is simple. They're making a lot more money, but they are spending it even faster to fuel future growth.
Okay, Section 3, commercial portfolio growth.
What's genuinely fascinating about this Q1 revenue mix is just how beautifully diversified MannKind's revenue stream has become. I mean, just a short time ago, this company was heavily dependent on Afrezza, their inhaled insulin product. But when you break it down today, Afrezza brought in $15.2 million, and Furoscix actually edged it out slightly at $15.4 million. Meanwhile, collaborations brought in $23.5 million, and royalties, which are largely driven by their Tyvaso DPI partnership with United Therapeutics, completely dominated at $32.7 million. This level of diversification severely reduces their risk of relying on just one single product. Actually, let's talk about Furoscix for a second because, man, this was a masterful M&A move. In late 2025, MannKind successfully acquired SCOS Pharmaceuticals. This instantly beefed up their cardiometabolic franchise, and the impact was immediate. Furoscix generated $23 million in net sales in Q4 2025 alone, right after the acquisition closed. It's a textbook example of strategic capital allocation driving immediate top-line results, and it really validates management's aggressive expansion strategy.
Which brings us to Section 4, 2026 Pipeline Catalysts. So, MannKind is definitely not just resting on their laurels with their current portfolio. As they've outlined in their recent corporate updates, they are actively targeting some massive FDA milestones this year. We're talking about both line extensions for their current drugs and entirely new therapeutic applications. Let's actually map out this timeline because these dates are absolutely crucial if you're doing your homework. In Q2 2026, they anticipate enrolling the very first patient in the phase 2 trial for nitadenab DPI for pulmonary fibrosis. Then, on May 29th, we hit a massive catalyst, the FDA's target action date, or PDUFA date, for Afrezza in pediatric patients. If this gets approved, it would literally be the first needle-free insulin option for kids in over a century. Just think about how life-changing that is for families dealing with childhood diabetes. Then, jumping to July 26th, we have another PDUFA date, this time for the Furoscix ReadyFlow autoinjector, which could massively scale that brand's growth. And finally, in the second half of the year, we'll get the phase 1b data for nintedanib. These are exactly the tangible, concrete milestones the CEO was hyping up earlier.
And you know what? This innovation moat actually extends way beyond their internal pipeline to build their external capital too. Their collaboration with United Therapeutics to develop ralinepag DPI recently hit a big milestone, bringing in an additional $5 million to support accelerated development. This just proves that their proprietary Technosphere platform is highly valued by major partners, which creates secondary streams of revenue that don't require MannKind to foot the entire R&D bill themselves.
Finally, Section 5, Risks and our final verdict. So let's take a step back and impartially review the risk factors straight from their SEC filings. Because the road to 2026, it could easily hit some speed bumps. We're talking unforeseen clinical trial delays, or safety complications in these trials, and regulatory review setbacks from the FDA regarding those upcoming PDUFA dates could instantly, and I mean instantly, shift market sentiment. Plus, even if a drug gets approved, there are always manufacturing risks and market adoption hurdles. Because, let's be real, just because a drug gets approved doesn't guarantee doctors will immediately start prescribing it. That bearish DCF model we looked at earlier, it's essentially pricing in the probability of these exact hurdles occurring.
So that brings us to the million-dollar question that you have to answer for yourself. Will MannKind's 2026 pipeline catalysts outpace its current valuation? You've seen all the data. You have a bearish DCF model pointing to a 25% downside based on current cash burns. But then you contrast that sharply against surging revenues, a brilliantly diversified portfolio, and a string of massive FDA target dates right on the horizon. The financials show a company that is spending aggressively to secure its future. Keep a very close eye on those May and July FDA dates. They are likely going to be the ultimate decider in solving this valuation paradox. Thanks so much for joining me on this explainer, and keep learning.